marketplace. Now, a little bit more about the small balance market. Let's get some additional insight from our experts and turn to the body of our discussion today. Steve, let's start with you. Most people are familiar with Freddie Mac, but they may not know that Freddie Mac does small multifamily loans. First, tell us what brings Freddie Mac to the small loan market.
So first off, thank you to Ivan and Sam for inviting me. It's Arbor and Ivan are certainly an institution in this business, and we couldn't be more pleased with the partnership. So I thank you, Ivan, and again, Sam, for inviting me. But I think the most important thing is our commitment, energy, creativity. We've wanted to be in the small balance loan for a very, very long time. So what you're going to find is a kind of commitment that you're not going to see in other types of businesses or other types of competitors that are out there. We've wanted to be in this business. We needed to be in this business, and we are here. We've created an entire business line around this business. We're not sharing resources with anyone. So that's the kind of commitment you're going to have from Freddie Mac. I think more specifically, we're a nationwide program. We are interested in innovating. We are interested in finding ways to deliver capital, to deliver liquidity, keep it simple, certainty of execution, low cost, defined process, and again, back to this commitment, experts who are positioned in your markets, who understand what they're looking for. We did over 1,000 loans last year. We've done 1,700 loans this year in our business. We're getting awfully good at identifying those assets that we are interested in, and along with our partnership with Arbor, I think we're able to really change the game, deliver creativity, solutions, and really address the needs of the borrowers out there today. So it's a bit on that.
Now, I know that the program at Freddie Mac is new. You launched in October of 2014. You're less than 2 years into the small balance lending program. In terms of the level of activity, your ability to engage the market, the health of the small balance market, has it met your expectations?
It has met and exceeded our expectations. As you see the slide, that's the kind of thing you want to see when you start a new business over the course of a year, although I would say we'd like to see the dramatic increase maybe a little bit earlier from launch, but absolutely has exceeded our expectations. I think our original expectations around funding volume may have been $1.5 billion, and I'm sure as Ivan does in his business, management looked at me and said, okay, it was $1.5 billion and things are looking awfully good, so now your goal is $1.7 billion. Now it's 2, now it's 2.2. So we believe the market is incredibly strong. And this year we, to date, have funded over 700 loans, and we expect to do probably somewhere north of $3.5 billion for a full year. So very excited about the business. Again, a few things just about what we've done to try and position ourselves. We have leveraged the strengths of our existing business model. Again, our people, our credit culture. I can't stress that enough, our credit culture and our knowledge of the market. Again, our commitment, we're really able to focus on the point of this business, which is workforce housing. And we do that through competitive pricing, a well-defined process, and people at the street level.
And I want to ask a little bit about that, because it's not just the case that the program is servicing the small balance borrower. By extension, you are helping to address a need for housing in the workforce space. Tell us a little bit about what that is.
Well, the most important thing, I think, is that we worked with Arbor, with institutions who have been in this business, to design a product specifically for the need out there today. So that's what we specifically did. We haven't been around a long time, but we got together and put together, I think, a product that actually addresses a variety of needs. And frankly, the combination of these various components make it hard to compete with. Things like a hybrid product, 80% full leverage in certain markets, the inclusion of IO, non-recourse, based on who we thought the borrower was. We thought a coupon pricing made more sense, so a borrower would understand that easier than some sort of spread over a treasury. And then our step-down prepayment, again, something that has been toyed with around the edges, but has not been something that I think is delivered in mass, and we were able to do that. And through our partnership, we were able to identify these important components.
Now, over the last nearly 2 years that you've been in this market, have you seen changes or evolution in the financing options that are available?
Oh, I think that where we've seen the most change, and I would sort of position this as maybe a bit more of a surprise. I think that we thought this business was going to be 90% widget making, so through sort of a manufacturing approach, and then maybe 10% hands-on. What we found is there's a need for creativity out there. So although I wouldn't say that we've gone in and tinkered too substantially with the components, we've certainly tinkered with our markets. So specifically what we would define as a top market, a standard market, small and very small. We've adjusted those as we've had experience throughout the year. But what's most important, we found there's an absolute need for people talking to people. Our model, we have human beings underwriting risk. And what we found is you may have a borrower out there who has an asset they'd like to potentially cash out, refi, and purchase 2 or 3 other assets, or they've got a story to tell. We're awfully good at that. And we brought that kind of culture from our conventional program. So do I think that there's lots of movement in the product itself over the last year? I wouldn't say that. Some around markets, some around just that normal experience gains you. Again, we'll have done 1,600 loans at this point, so we're getting awfully good at this. But it's more about the people-to-people touch that we can provide. It's that creativity. It's hearing a story and being able to figure out whether or not we're able to do that loan or not. That part surprised me, and I'm pleasantly surprised because I think it's an advantage that both Arbor and Freddie Mac can provide.
Well, and tell me about some of the alternatives out there. What are going to be the advantages for a borrower of a relationship with Freddie, as perhaps compared to borrowing from a bank or through a CMBS channel?
Well, I think first of all, the borrower we're looking for specifically, and we talk a little bit about eligibility, and we have a slide up there, so I won't get too far into the slide itself. But what we're looking for are long-term partnerships with borrowers who are passionate about workforce housing. And workforce housing can be defined in a bunch of different ways. Workforce housing to us means those folks, those firemen, those nurses, those policemen in those areas. That's workforce housing to us as it's defined. When we work with borrowers, we're looking for passion, we're looking for local expertise, we're looking for folks who have reinvested in their properties, we're looking for folks with a portfolio of small balance loans, that they understand that simply putting an ad or a sign out in front of their asset is not necessarily going to fill it up. We need people that understand that. So really, and frankly, once we have those types of relationships, and we believe that this does exist, small balance isn't one and done kind of business. This is a business where you go out there, you do what is expected of you, do quickly, you deliver on time, and that's a relationship that's going to continue until all of their financing needs are met.
You know as well as anyone that the base of investors and borrowers in multifamily is incredibly diverse. Can you actually walk us through this eligibility slide of the borrowers in multifamily, who really is eligible for the program?
Sure. So again, and I mentioned this before, I think we are looking for experience. We have adjusted liquidity and guarantor requirements. I won't get into that very specifically, but that are more designed for a balanced borrower. But look, we are nationwide. We are looking to lend. My good partner, Mike Patterson, who runs the credit side of our shop, always talks about the fact we're here to lend. And what that means is if you look at this slide, there's not an awful lot of no's on here. There's a few case-by-cases, and there's a whole bunch of yeses. And I think what we're trying to reflect there is we have a credit culture, we have an experience where we can look at assets, certainly experience, local experience, a track record of performance, of really smart record keeping, understanding that income is very important. All of these are the things we're going to want to see. And there's a couple things that we're not going to get into, specifically duplexes or purpose-built types of assets. But overall, if you are a small balance borrower, you have a couple of assets. If you looked at this list, you're probably going to say to yourself, this is worth looking into. And I think that's the point, and that's what we want to get across to you today.
Can you give us some examples, maybe walk us through a couple of cases where you've been a lender?
Sure, and I think one specifically that we'll put up is an example of what I talked about before around this creativity meaning something, around this idea that it isn't necessarily just widget making. And really, again, we have people in every market. So if you didn't have people out on the West Coast who understood Portland, Oregon, what would you feel comfortable doing this kind of deal? I don't know. You may or may not. I think that being there and seeing people, being a part of those communities, means you have expertise that puts you at an advantage over your competitors. So that's incredibly important to us. But this is a perfect example where we looked at an asset. We had a borrower who wanted to work with us for specifically around cash out to then go and purchase three other properties. We met with the borrower. We worked through the entire transaction, and we got comfortable with it. And really, cash out refis, what you're looking for, again, accurate records, long-term ownership, property maintenance. You want to see a lot of deferred maintenance around the properties, and some stability in expenses, income, and occupancy. So this is a great example of what I just mentioned about knowing borrowers, building relationships with borrowers. My sense that this borrower at some point is going to say, the bottom right deal, purchase number 3, you're going to want to refinance that or leverage that deal potentially for other purchases. And I think they're going to remember